Snowflake just released their quarterly numbers, and unlike last quarter, where last quarter one, there was the announcement that the CEO is leaving, and two, guidance was quite weak, and so the stock crashed around 20-25% or so. Right now, it's actually the opposite. The stock is up 3%, 4%, depending on when you're going to watch this video. This quarter was a good quarter, a beat across the board, but in my opinion, there are still some things that just don't seem quite right to me. Can be that they're still sandbagging when it comes to guidance. Right now, it still is very, very expensive, especially since you're not getting a guidance raise or any big beats or any big boosts in profitability or profit margins, should I say. It's a market cap of close to $55 billion, forward PE 173.3 times, EV to sales 14.6 times. Yes, it is a company that is growing quite fast. You're paying around 10 times sales for fiscal year 2027, which is okay-ish, I would say, for a company that is expected to grow so much. But if that's the case, then usually you want to see guidance being raised. Maybe again, it's going to take a while. New CEO coming in, new product launches. It's still not baked into guidance. And so that's what we're getting right now. Can be that next quarter we have, again, a good quarter, and then suddenly full year guidance is raised and the stock goes up by a lot. It can happen. Now, by the way, another problem with Snowflake is that around 40% of revenue is SBC. But to tackle that, they are buying back shares. You might say, why are they buying back share at these valuations? Just doesn't make any sense. Basically, so you don't get hit that much with regards to SBC. But SBC as a percentage of revenue at 40% and not really decreasing much, definitely not the best thing. Maybe in the future that will decrease. Hopefully it will, to be honest. Hopefully it will. Again, it's a very, very good company. I can see why there's a lot of, I won't say hype, but attention going to it. Very good company. Stock is expensive. Let's have a look at the results. If you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, we just covered NVIDIA's earnings report as well. That will be in the top right corner. If you enjoy this type of videos and want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's start with a big snapshot of the quarter. Product revenue increased 34% year over year, which of course, it beat the expectations, but the expectations were quite low. So that came in at $789.6 million. Net revenue retention rate, 128%. It's down from 131%, but still world-class numbers here. Total customers increased 21% year over year. Customers that spend over $1 million, that's a 30% year over year growth. So quite impressive. Forbes Global 2000 customer, that's an increase of 8%, same as last quarter. Marketplace listing increased 6% quarter over quarter and 35% year over year. So all well and good. I do want to mention this. This is from Jamin Bol on X. Snowflake net new ARR year over year growth. We can see a clear reacceleration here. And so let's dive a little bit deeper. First, a couple of comments here. We finished our first quarter with strong performance across many of our key metrics. Product revenue is up 34% year over year, while remaining performance obligations were $5 billion, up 46% year over year. Our core business is very strong. Our AI products, now generally available, are generating strong customer interest. They will help our customers deliver effective and efficient AI-powered experiences faster than ever. They also said today that they announced its intent to acquire certain technology assets and hire key employees from TruEra, an AI observability platform. Moving on here to the presentation, again showing us the partner ecosystem and the thousands of customers here, definitely some big companies that are using Snowflake. Now you're probably going to see this slide and say, oh, that's a big red flag, right? Yeah, maybe, but this was not sustainable, right? To stay at above 150% or so. I don't think there is one company on this planet that has these types of metrics. Still, 128% net revenue retention rate is very, very respectable. With regards to gross margin or product gross margin on non-GAAP basis, that increased 2 percentage points year over year. With regards to free cash flow and adjusted free cash flow, $332 million and $366 million respectively. And before I forget, repurchases of common stock, $516 million for this quarter. And so looking at guidance right now for fiscal year 2025, revenue is up a little bit, product revenue growth is up a little bit as well from the prior guidance, but all the rest here is actually down. Non-GAAP product gross margin is at 75%, non-GAAP operating margin at just 3%, and non-GAAP adjusted free cash flow margin at 26%. All of those metrics are down from a quarter ago, which again might be them sandbagging guidance, but if that's the case, then we will definitely need to see some big results or some big, let's say, raises in the coming quarter or two. Then with regards to second quarter guidance, product revenue to come between $805 to $810 million. That's between 26 to 27% year over year growth. With regards to operating income, non-GAAP basis, only a 3% margin. And so right now, looking at the stock, it seems like we might open just under the 200-day moving average. So it will be quite a battle to watch if we can actually break through that. If we can, then of course the road towards where we were before the previous earnings is in play. I think it will take a while until we reach those highs again, because that would mean that currently the stock is looking quite cheap compared to what it will be if it reaches around $230 with the current guidance. Now overall for the stock, if we zoom out a little bit, it has been making higher lows, which is a positive thing. And of course, as the business grows and accelerates and will become more profitable over time, the cheaper you can buy your shares, the better. So overall, to conclude, remains to be seen what happens in the coming quarters. Right now, guidance doesn't really give me that much confidence. It's again, a very, very fast growing company. Nobody's denying that, right? Product revenue growth, revenue as a whole is growing quite fast. But when you look at all the profit metrics, it's not really giving you that much confidence. Maybe right now they're like, look, short term, we want to accelerate, we want to grow as fast as possible. And so right now in the next coming quarters, you're not going to see our margin expand that much or at all. But maybe exiting 2024, going to 2025, this is what we're going to hear. In 2025, we're going to have margin expansion, etc., etc. Remains to be seen. Those are just my thoughts right now. Of course, I can be completely wrong, but I do think that this is quite a good company. I don't think it's a company that now is worth $55 billion just because it's all AI hype, just because it had a big IPO, had big backers, etc., etc. And that's why everybody's talking about that. No, I think this is truly a very, very good company, a company that we will see in the future being worth probably more than just $55 billion. Let's wait and see. Of course, these are just my thoughts. Leave your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, and I'll see you all in the next one. Bye-bye.